All right. Today we're live on the socials. All right. Let's get started. Hello, Smart Money podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk. Welcome back from vacation. How was it?
It was great. It was great. Had a lot of fun. This is the first time in like 15 years that it rained on vacation. So we had one great day, and then the next few days were mediocre. Let's just say there was a hurricane off the coast. It was really windy, not great weather. And fortunately, I think it only rained one day, but it was not great beach weather. It was still a vacation. It was fine. For me, I'm just like, whatever. I don't care. But everyone else is like, I want to go home. This is not fun. I'm like, just, like it's vacation. Just relax.
It's a trip, Kirk. As a mutual friend, Craig has always told me, if you're going by yourself, doing whatever you want, it's a vacation. If you were going with family, it's a trip. You push through.
Yeah, I would say when it was just me and my wife, it was vacations too. But when we started to have kids, the way I described it, it was, especially when they're young, is it's home somewhere else. Mm-hmm. It's like home without the childproofing when they're young, because you're just in some other house with no childproofing. You're like, where the hell is everything? But now they're older. They're just, honestly, it's the same as home. They're cranky. Like, what do we do? I'm bored. I'm like, okay. Like they don't have their electronics, so they're bored. Like, all right, we'll play with each other. Your brothers, you should be able to figure it out. I know it's tough, but at that age, they don't want to sit down and read. Like we do. But anyway, so it was fun.
I believe these are called first world problems.
Yeah, there's leaves in my pool kind of problem. Yes, that is very true. Very true. Yeah, you got that one before I did. That's very true. But yeah, so it was a good vacation, and then topped it all off. My oldest son wants to go hunting with his friend, or more likely, his friend wants to go hunting with him. So his friend does his hunts, and my son wants to learn. So we took a hunter's ed course yesterday at this place, Swift River Club. Mm-hmm. It is absolutely beautiful. I mean, this place is pristine, and I can tell you, like, I'm looking at these pictures, like, I want to live here. Like, it is the most beautiful property. 400 acres. It's not like a high-end club. But it looks really nice. So
that's awesome.
Yeah, it's absolutely beautiful. So we might go down there with him. But anyway,
so is this a hunting club, or is it like a gun range to prepare to go hunting?
It's a sportsman's club with ranges. There's archery, with like a really long open archery range, which I haven't seen local. There's a bunch of gun ranges, and there's 400 acres of hunting property.
That's awesome.
So we had, it was really cool. I have to say, like, I'm not really a hunter. It's not really my thing, but like, I enjoyed the experience. So we're there, and we had like, it was all day. So it was all day. We had like 8 sessions. We went to the, one of the officers of the environmental, I don't know what they call it. Basically, it's Fish and Game, but it was Mass Environmental something or other. Mm-hmm. So he came on, talked. He was really cool, and you'd think it was like, oh, the guy's just like a turd sandwich trying to scare everybody. No, he was really cool. He's like, I hunt too. He's like, it's a really great thing. And what I was amazed at was the if you watch the news, which I don't, we're talking about the show. The news tells you all hunters are all drunken idiots, and they're all drunken rednecks, like shooting guns in the air. These are probably the most like ethical people I've met in a long time, who really respect the sport, respect the environment, respect wildlife. Like it was just, to me, it was very eye-opening. It was a really cool experience. So you get all these people around, and they're talking about how to ethically hunt. Like, you got this deer right here and it looks like this. Do you shoot it? And we're like, no, you don't, because it was really cool to get in the head of people that hunt and understand how they think and why they think. And it was just, to me, it was just a really cool group of ethics, which you don't see in society anymore, frankly. But it was just, I know some people don't like hunting and some people might not like this segment in the show, but I was really taken aback, and it was just a good experience. And I have to say, and I think even if you don't hunt, I think a lot of people should go through this, because it was really cool to see and to learn just about how to do things properly and how to be safe. And it was good. I enjoyed it quite a bit. So.
It's very educational. I know there's a lot of people who are find it to be controversial, and the argument is for or against hunting. Unfortunately, whether right or wrong, we have eliminated a lot of the top predators out there, and we're trying to reintroduce some, which is controversial. They're trying to add wolves back in different areas and things like that, which have actually help the deer population. They take out the sick, but if you look at kind of the regulators that are involved, like you talked about the DNR or whatever, the individual that spoke, it is one of the few places where the regulators that are involved with it are actually the sportsmen themselves. And that there's a lot of the regulations that go into that are to try to create a situation in which it is a great balance between both the sport and an ethical way of basically replacing the top predator that is no longer there. And so, I know there's people that don't like the crackdown, and I know we talk about regulations and things like that, but this is one of those areas where the regulation is actually, it's actually conservation, and the regulators are very much involved with it from a personal vesting. And, even the fees that you pay to hunt in different states and things like that, it's one of the more efficient injections of, municipal capital that goes back towards a good cause, right? They reinvested in more lands, they reinvested in education, things like that.
They talked about the fees that you pay for the permits and all that. It goes to stocking the wildlife, so you can
100%, yeah.
And what was interesting is there's a lot of things I didn't know. Like, for example, black bear in Massachusetts are a complete nuisance, and not enough people are hunting them. And they're actually, the guy talked about it. He's like, we need to kill about 550 black bear a year, and right now we're killing about 250. He's like, it's a problem, and they're getting out of control, and they're being a nuisance to people. They're going to people's houses. Like, it's a problem. No, not the whole state, but in a lot of parts of the state. He's like, we really need more black bear hunters. And I'm thinking, I don't want to kill Yogi the bear, but it's, when they become a nuisance, something has to be done, right?
Yogi's a brown bear. You're good.
That's true. They're the scary ones, aren't they?
Right.
Yeah. So
the old saying, Kirk, is for a black bear, run; for a brown bear, lay down; for a polar bear, you're dead. You're down. Bear. You're dead.
So. Grizzly bear, nothing you can do. Yeah.
Run, play dead, you're dead. Yes.
Yeah. So he was, and the warden was telling us, he was telling us a story about New Jersey. He's like New Jersey. Oh, actually, no, it wasn't the warden. It was one of the educators. So they were talking about New Jersey. He's like, I just was in New Jersey. I went to my friend's farm. He's like, these deer are a nuisance. And in New Jersey, you can kill as many does as you want because they're so overrun that here's a funny thing, that the insurance industry told the state, if you don't start expanding hunting in deer, we are no longer going to insure your cars. That's how big of a problem is in New Jersey, because so many cars get hit by deer jumping in the road that the insurance are like, this is a problem. We're not going to insure your cars. So the state's like, all right. I mean, this is crazy to think about, that the insurance companies are like, kill more deer because we're losing money. And that's how law happens, So anyway, The point is this guy was sitting there. He's like, I killed 5 deer in 45 minutes. They all just kept walking by, and he just kept plinging them. But to me, in Massachusetts, I think the cap's like 2. So it's just interesting to see how the state regulates the environment. It's not just, you're killing something. It's like, no, these are nuisances, like you said, Doug, because you're killing the predator, or the predators get killed off by humans, and now we're the predators. Like you need to monitor it. So they actually do. I have to say, I give them a lot of credit. I don't give government agencies a lot of credit. These guys, I give a lot of credit. They're very thoughtful about what they're doing. Like you said, a lot of hunters are a part of it. Very cool. Like I said, very cool experience. I'm not really a hunter. I'm just doing it because my son wants to do it. I don't know if I'll be shooting anything, but it's a really cool thing, and I'm glad I did it. So,
well, I'm going to add the last thing on this before we move on. So you talked about the does, unlimited does. So it used to be that hunters took out more does, and does actually from a culinary standpoint, much better tasting. Bucks have hormones when they get in rut, tarsal glands, too much technical. It actually adds a real muskiness, funkiness, and if you get it in, it can actually make it, much, much less desirable. So somewhere along the lines, though, it became the sport of getting, the big rack, and having, the big buck. So there was a shift, and I read an article on this probably about a year ago, where there was a shift at some point where everybody started going after bucks, and it was the big thing to take bucks. And now everybody wants that, everyone wants that trophy. So now in many states, there is a significant under harvesting. That's the nice word that they use for it. Under harvesting of does, to where many states, like you were just referencing, are actually trying to push and encourage, go after does. We need you to hunt more does. We're not hunting enough does. And it's because it's creating a massive population issue. And again, if you're not you're into the sport. But if you're not just into it for the sport of it, don't get me wrong. I've got some beautiful racks on my wall. Love a good buck when they come along. But, the does are fantastic. And I'm actually a little envious. If I could go to a state where the does are unlimited, as we're all, our philosophy when we hunt is, antlers don't taste good. So.
Yeah. Yeah. No, it's interesting. Like I said, I know you're a hunter. I'm not. I'm enjoying the education and the sport. Now I'll go with my son, but I'm not sure if that's going to be my thing. I have a lot of friends who hunt, and it's, I think it's a cool sport. I'm not sure if I can get over killing something, but whatever it is.
I just sous vide some beautiful back straps the other night. So yes,
I love venison. So
here it comes. Well, you got to just a little education for you, Kirk. There's only one way to get it.
Well, here's the way to think about it, Doug. Someone has to do it.
Yeah.
If it's not me, it's someone else. So it's just like, it's like people who eat hamburger. Like, oh, I don't want to kill a cow. Like, someone's doing it. You're just not seeing it done. So it's like if you're a meat eater, it happens. Someone's doing it. Maybe you just feel ethically like you don't want to do it. But, we all got to eat. So the way I've always thought about it philosophically, and we'll move on because I'm sure that some of the listeners are lost people, but the way I've always kind of looked at it is like, as long as I'm eating it, I don't have a problem with it ethically. Like if I'm shooting it, I'm eating it. Like
100%.
Love it. Like I love venison, and you could fill your freezer for like months. I'm cool with that because, if you go back hundreds of years when people were shooting their own food, like they did it then, it's the same thing. I'm not shooting it and leaving it there for the crows. Like you just, doing it all in the right respect of it, not just like shooting shit and leaving it out there. Like that's irresponsible.
Even the controversial, you hear about the people, I can't believe they went out and hunted those big African animals. Just an FYI to everybody, all the meat from those typically gets donated to local tribes and they get consumed. They are not wasted at any level. So it's an FYI.
Yeah, even there was something we read. It was like donate your meat if you have enough. Like there's a place you can donate for other people. So like Mass Food Bank or something. Anyway, like I said, a lot of thought is put into it. I don't give government agencies a lot of credit. I think these guys and gals are run well in Massachusetts. Maybe the only agency that's run well. Anyway, moving on. So I was on vacation this week, so I'm just going to go over a bunch of stuff that I found interesting. I'm not 100% up to speed with what's happened because I try to take a break during my vacation. I'll tell you, this is the second vacation I've taken off mentally in like the last 25 years. Usually I'm still on. But anyway, so I want to go over a few things that I saw, a few charts that I found interesting. So one of the things that I found interesting was you're talking about like alternatives. Now, I want to go over this quick educational segment here. Now, when it comes to alternatives, the word alternative investments is in some sense a fabricated word, kind of like the term financial advisor. Financial advisor has no technical meaning. You could be be pumping gas at a gas station as your primary job, and you can call yourself a financial advisor. There is no requirement to call yourself a financial advisor.
It's not even spelled right.
Yeah, well, your spelling depends on where you are. But if you think about other professions, there are requirements. Now, to be a CFP, there's a requirement. To be an insurance, to be a registered representative. So there are certain titles that actually do have requirements. Registered rep is Series 7. Investment advisor representative is Series 65. So there are certain titles, but no one uses those. But if you're a financial advisor, there's no, but that's what everybody uses, but people don't. So you could pretty much call yourself whatever you want. So I call myself a wealth manager. Everyone's got their own thing they want to call themselves, but there is no requirement for that title. So alternative investments are similar. Alternative investments, you'd say, well, what does that mean? Well, if you're on Wall Street, alternative investments means hedge fund, private equity, private credit, venture capital. And I think it was about 10 years ago, they got a hold of the term and they started to create mutual funds that are alternative investments. Well, they're not alternative investments. They're alternative styles. So there's still stocks, bonds, and commodities. Commodities are alternative in Wall Street terms. So like a gold ETF would be an alternative for them. Or if you've got an alternative strategy, like a long short strategy, or if you've got some options in there, they call that alternative. So basically all alternatives on Wall Street is anything that's not buy and hold equities or buy and hold bonds. That's kind of how Wall Street describes it. Now, we specialize in self-directed IRAs, alternative assets held in a retirement account. Now, the term self-directed, we won't get down that rabbit hole, but basically what it means is you can invest in virtually anything inside your retirement account. You can invest in real estate, tax liens, private company stock, crypto, payday loans, private mortgages, physical gold. You can invest in virtually anything. Things you can't invest in are collectibles, life insurance on yourself, and an S corp. Everything else you can invest in there's some restrictions, but basically every other asset you can invest in. Now, Wall Street doesn't consider that alternative. I do, because those are assets that are not securitized. So my term of alternative, which I think is probably a more truer term, is non-securitized assets. So a securitized asset would be a stock, a bond, a mutual fund, anything that the SEC basically oversees is not everything, but everything that's considered a security. Those are traditional. CDs, even though they're not securitized, I would put in the traditional bucket because everyone knows them. They're through a bank. But any sort of alternative asset would be something that's not regulated, that's not a security. I would put in the alternative bucket. Now, so if you have a private equity, that would be an alternative. If you have a movie, motion picture tax credits, that'd be an alternative. Investing in a movie, film, whatever, alternative. Like there's so many alternatives. Domain names, we could go on forever. Anyway, point being is I wanted to start with that naming because it is one of those areas that there is not really a true agreed upon name. And I think the most accurate way to do it is by securitization. So if you look at alternatives, most alternatives are not in a fund. Now, if you're investing big money and you're investing with managers, most of them are all in a fund because they have to. If they have multiple investors, they pool them all together and it's easier. Doug and I are financial advisors and we don't run funds. We run individual accounts. So each person has their own account. We manage that account for them and we oversee it and, buy, sell, whatever we need to do. Right. But it's your account ultimately. With a fund, it's a pooled account and you own a piece of that fund. Right. That's the difference. So it's like a mutual fund, right? A mutual fund, you own shares in the mutual fund. in a let's say a private equity fund, same kind of deal, right? There's $1 million, you put in 10,000, you own 1% of that fund. That's how it works. Now, if you think about alternatives, they're all over the map. There's lots of different kinds, but there is a market for alternatives. And I saw these 3 charts, and I thought that was interesting. And the stat was, of all the alternative mutual funds that have been out there, 75% have died. And so I want to share these charts. The breakdown of alternative funds, the lifespan since 2014 that have died, about 13% died within a year. Within 3 years, about 96%, somewhere thereabouts. These numbers don't. Oh, these are the number of funds. Got it. Okay. So there's about 13 have died within the first year. About 96, 97 died within 3 years. About 70, a little less than 70 within 5 years. Within 10, about 65, and then over 10. Less than 10. So this is Morningstar data. I thought it was interesting. And I don't know why they died. They didn't give that context, but it's just funds that have wrapped up. Now, the question is, did they die normally? Because a lot of funds actually only last 10 years, where their lifespan is 10 years. So the question is, did they die a normal death, or did they die from being defunct for some other reason? I don't know that. It says here subsequently merged or liquidated away. Well, that's normal, right? So it looks like most of them are between 1 and 10 years. I think that's normal. Here are the ones. Here's the breakdown of funds since by inception, whether they live or died, and it shows most of them died within. If you look at the context, most of them died. Now, if you're just looking at this Morningstar data, you'd be like, "Oh, alternative funds are terrible." Well, I just picked this up. Like I said, I'm a little fuzzy. I just got back from vacation. As I'm looking at this, I realized that actually this makes more sense, because if you look at the numbers in 2020, and I think this only goes 2020. So very few died. In percentage terms, is probably like 10%, I would guess. It's hard to tell, but it looks like about 10%. And then maybe about 15, 18% in 2019. And then 2018, it looks like there's about 50-50, and then it grows. So the question is did they die because they were liquidated? Because that's the normal course. Once you get through an investment, you liquidate it and start a new fund. To me, that's what it looks like. It's hard to see if you don't know the industry, but it looks like that most of the stuff was just liquidated. I don't know, because they didn't break it apart. It would have been good to have a chart that showed like how many died versus how many were liquidated. But this looks like a borderline chart crime from Morningstar, because I didn't see any context with this. And then here's kind of the rolling 12 months of net flows. This is actually more interesting. So this shows rolling net flows. So this is money in and out of alternative funds. It looks like it's kind of up and down, around a little bit above zero. It looks like maybe about 10 billion on average. It's big ranges between 50 and negative 25, but it looks like the average is about 10 billion with some huge swings. Right now, it's about 15 billion. So interesting. It's on the rise. A lot of people are interested in private credit. But yeah, I love alternatives. I don't love alternative funds. I just want to say this, and then we'll kind of move it on to Doug. The thing to understand about alternatives are sexy. They're different. They make people say, "Oh, that's cool. I can brag about it to my buddies at the golf club." I mean, when you talk about people with a certain amount of wealth, there is a element of this which is not about investing. It's about bragging. Oh, I got into this fund. You didn't. This is an exclusive fund. Only the uber wealthy people get into. You didn't get into this. There's a huge element to this not in the ultra high net worth, but in the high net worth category, where it's a lot of people at the golf club like to brag about these things. I'm just telling you, this is what happens. It's normal. I don't agree with it, but I've got clients like this, and I get it. I understand. But at the same point, if you're talking about true investing, alternatives are good because they can, not necessarily, they can provide true diversification. Now, what is proper diversification? Most people think it's just a bunch of mutual funds or stocks, and that's diversification. No, it's not. True diversification, if you really understand how it was created, this concept was created, I think it was in the 70s from an academic paper. And a professor wrote about this, and it was really good data. And a Wall Street guy got a hold of it and said, this will allow me to sell more mutual funds. And they took it and they bastardized it. And now it is modern portfolio theory. And what modern portfolio theory is, have a bunch of mutual funds, have large, mid, small cap, have some bonds, have some international, maybe some emerging market. I don't know about commodities because those aren't sexy anymore. But, it's like we're going to hit all these buckets. So if you're over at one of the major custodians, Fidelity, they have a team that diversifies you, and you could be in 50 different mutual funds, not because it's the right thing to do, but because if you put too much in one mutual fund, it will overwhelm it and get too big. It is an operational problem. And I'm just saying this because I have a friend who works at one of these companies, and this is how they do it. So I've been told, because you can't put all your money in Magellan or it overwhelm it, or actually the small caps are the problem. Anyway, so point being is diversification between mutual funds no longer works. And I'll get into this in a minute, but just understand that diversification for the sake of diversification is not what works. True diversification is a diversified portfolio of non-correlated assets. The key, non-correlated assets. Now, what does that mean? Now, if you look at, you don't see them often. I don't have one at my ready, but sometimes you'll see charts of asset correlations. You'll see it's usually a vertical and a horizontal, and it'll show all the assets, and it'll be a grid, right? And the diagonal will be the same, so that's blocked out. But basically, you see a grid, and it'll show correlations between different assets. Now, what you want to look for are assets that have a zero or even negative correlation to other assets, because you want to see that investing in gold has a 0.2 correlation to the S&P.
Hey, Kirk, I just dropped one in for you if you want to share it.
Oh, cool. Thanks, Doug.
Yeah, sure.
So let me pull that up. Doug's quicker than I am right now. Maybe always, but right now especially.
You're talking. I just get to sit back here and play.
So let's see if I can do this. So it's okay. There we go. All right. Historical correlation for the last 10 years. Okay. So it's comparing bonds, cash, commodities, currencies. Oh, this is actually a pretty good one. I'll give him credit.
This is from Guggenheim, which is pretty reputable.
Yeah, this is a good one. So if I look at this, it's basically showing a grid. And actually, this is better than I would have expected. The last time I saw one,
here's the thing I'm going to say: the people that put this together, they actually specialize in doing a lot of alternative types of funds. So,
well, if you notice here, these are actually alternative funds. So as I'm looking at this now, I'm realizing this is mostly alternative. So if you look at
there might be a reason I grabbed that one for you. Anyway,
yeah, maybe. Yeah. So S&P versus REITs 0.78. If you're looking at, S&P versus investment grade bonds, you're looking at 0.37. That's weird. Usually those are negative. Managed futures are negative. Commodities are negative, which is good. You have hedge funds 0.14. Well, that's the whole point of a hedge fund. So kudos to them. 0.12 on cash. That's good. Equity market neutral. That's basically delta neutral, which I won't get into, but 0.2. Event driven 0.17. Yeah. So those are the good ones. But if you look at REITs 0.58, if you look at investment grade bonds 0.37, which it should be negative. So this is actually better than normal. But if you look at like large, mid, small cap, international, you're probably going to see a lot of 0.8, 0.7, 0.8s, which are not uncorrelated. So if you have a portfolio where everything's like 0.8 to each other, that's not uncorrelated. You might as well put all your money into the S&P 500. So
that's what Buffett recommends, because he's basically said people don't know what they're doing, so just throw it there.
That's not why, though. I agree. That's what he said, but that's not why. The reason he said is because if you don't know what you're doing, like you said, Doug, then that's his best solution. I actually don't know if that's the best solution or not. I've thought about it a lot, but I will say this: if you are trying to diversify yourself, it's really hard to do now. 20 years ago, you could do it. Now it's really hard to do without using alternatives. Now, these alternatives will help you do that. The question is, should you? That's a totally different question. You got to get access. You got to have enough money. If you can get access, the likelihood is you're probably not going to get the best of breed fund. If you think about the best hedge funds, the only way you have access is if you're worth 100 million and you put at least $1 million into the fund. That's the only way you get access to the top funds. And that excludes just about everybody. So, if somebody came to me the other day and said, "Hey, I have access to the top hedge funds. There's 10 of them. There's the best. There's David Einhorn. There's Ackman. There's Baupost. There's all these top funds. Like, you can get access." And I was looking at this thing. I'm like, this is a bag of shit. Like, I'm looking at this, and there's 10 funds, and they're all like the 10 best funds. You see the performance of the funds like 17, 25% returns. I'm like, wow, that's really cool. But you see my return, it's like 3%, 4% a year when everyone else is getting 20. Why? Because there's 10 layers of hands in the pie all taking a fee. So the net result is dog shit. Now, this is common. So if you're not worth $100 million and you're trying to get access through a fund of funds, just light your money on fire. Put it under the mattress. Those are better alternatives than this. You'll never catch me selling a fund of funds. It is just, it's a recipe for a disaster. I would never do it. So point being, just because something's diversified doesn't mean you should do it. It's an idealistic way to invest. And if you can do it, it's great. If you're investing in rental property that you're managing, and you're investing in the S&P, and you're investing in private companies that you're managing, you could probably get uncorrelated assets. Or as uncorrelated as you can get. You're never going to get truly uncorrelated. But the best thing I've ever seen, and actually it shows here, cash and currencies is negative 0.06, which is weird. Event driven in cash, negative 0.01. That's as close to uncorrelated as you're going to get. 0 is uncorrelated. Negative 0.01, that was the S&P versus Timberland back in 2001. That was that correlation. It was great. And now Timberland's correlated to the S&P, so you're not going to get that now. But you did get it at a point in time. Hedge funds in cash, negative 0.02, negative 0.04, managed futures. So cash and a bunch of stuff, there's some good ones. But do your research. Find an advisor who understands this. Most don't. Most just say you got a bunch of mutual funds, you're diversified. If they tell you that, find another advisor. I don't want to call them a donkey, but most advisors don't understand this stuff. Somebody tells them to diversify, their firm does, and they just do what they're told. But find someone who actually understands this stuff, because if you're just putting money in various mutual funds, you might as well just put it all in the S&P, because for the last 15 years or 20 years, investing international didn't do you any favors. You pretty much just put your money under the mattress. And so if you don't know what you're doing, you're going to get yourself in trouble. Most advisors don't when it comes to investing. So find one that does. And to find true diversification nowadays is really hard. I will just tell you, it is really hard to do. People who think they're getting it, it's just hard. I'm just going to just lay it out there. Anyway, so I just wanted to talk about that because it was a really interesting set of charts, and I love alternatives. It's one of my favorite things to invest in and to play around with, because if you can find some really good performing assets, The problem is they're not big enough. So if you're investing in, I'm trying to think. Oh, here's a good one. Motion picture film tax credits. If you're investing in that, really cool asset class. You can get a good return, very low risk, but you can't get access. I've tried. There's one guy in Massachusetts, one accountant who's in charge of all of the motion picture tax credits in Massachusetts. And basically, I don't know him, and he doesn't want any new friends. And he works with insurance companies. Like, it's a very closed system, and you can't get access. So there's some cool assets out there, but I couldn't put $100 million into those. There's just not enough money, right? You might be able to put $1 million in, and you take up a huge segment of it. Point being is this stuff exists, but it may not be investable in the traditional sense of the word. So, but it is an aspirational goal and should be. It should be an aspirational goal to invest in non-correlated assets. It's just really hard to do in this era when everything is institutionalized. And I will tell you, I did a research paper long ago. The reason that this thing happens is because of institutional money. That is the problem. That is the reason that this system's broken, is institutional money. Go ahead, Doug. Sorry, I talk way too long.
I don't know where to interject here. Several things I heard you talk about. I mean, again, there's some data I looked at this a while ago. I don't have it in front of me right now, but you were talking about, like, why do funds typically last 10 years? A lot. Listen, the first thing is, you got to remember, these funds are run by businesses, and what are these businesses trying to do? They're trying to market to you. They want to get inflows. They want to make money off of those inflows. It's not about the asset itself. It's about whether or not they can spark interest. One of the problems you find with our alternatives is it's not where the inflows are typically going, right? As you mentioned, most people don't understand alternatives. You've got your definition on inflow, on alternatives. My definition comes to kind of where you ended it, which is non-correlated. An alternative, to me, is anything that you can place in a portfolio that is going to do differently than what you normally have in there. And that could be anything, when we look at the chart, it ultimately a non-negative correlated asset is expected to underperform when, a comparable asset overperforms. A non-correlated asset is expected to do pretty much no pattern to what that does. And so, when I'll tell you a story. When you talked about marketing, you touched on it. I remember years ago, early in my career, somebody had come in to our office, and he had used to be with a former wirehouse. And the wirehouses, the big names, they've been consolidated a little bit, but they're in the business to make product. That's what they have always done. That's what they do now. They create product, whether that's creating the IPOs. And when you talk about access, why everybody wants to get in on an IPO, because it just sounds cool. And I got that invite. Do the data on it. Most of the people that get into IPOs, not that great of an outcome. There are the winners you hear about, but in many cases, not near as well as people would think. It's a ton of risk, but there's something cool about being invited into that syndicate, which is those that are allowed to kind of get behind the funding of it and then offer it to their preferred customers. This gentleman came around, and I came into my office and I saw some brochure on the desk. I said, why did you give this to me? Now, as Kirk and I talked about, Series 66, 65, CFP. The whole idea here, investment advisor, registered advisors, fiduciary standards, all of these things that have almost become cliche, but they were created to have standards and practices that look out for the best interest of the client. And so ultimately, I've always looked at that from a planning standpoint. A philosophy that is, hey, what's the problem we're trying to solve? What has the attributes to solve those problems? If then we go and figure out, get the things that have the attributes to solve the certain problems. Okay. That's always been the philosophy that I follow. Well, I said, why is this on my desk? He's like, well, I just got this thing came around. I said, but why do I care? He goes, well, it gives you something to talk about. Like, excuse me? Like, basically, it's new. It's cool. You can go in front of your client and say, by the way, my value today is I've got something shiny. It's like, that's unfortunately, and it's getting to be less and less. We do have a new the new model in the industry, a lot of people, even young coming right into the industry, are kind of going right into, having their own RIAs and more advice and getting away from, even investment and wealth management in some degrees as it's changed. But there's still a huge segment because those wirehouses are still very, very big, where it is all about create something shiny and new and throw it down your, push it down your throat. Where am I going with this? Well, let's go back to why these mutual funds or these ETFs fail. One of the big reasons they fail, it's not whether or not the asset was successful. Okay. And in many cases they're not. You mentioned hedge funds and the correlations of them. Hedge funds I've talked about this, in the past, but that's not, hedge funds started as options. That's what it was. Hedging. You buy options. Nowadays, hedge funds are all about speculation and the creative strategies that nobody can really fully understand what they're doing. It has completely evolved to a different level, a different type of investing. But it originally started as placing options against the markets to try to hedge that risk, hence the name. Now the idea of hedge funds is taking more risk, ironically, in many cases. So these companies go out in the mutual funds like, hey, alternative, shiny. I mean, I've been to these where people like get these groups around like, hey, get these advisors, say, you need to discuss alternatives. Why? They're saying without saying, it gives you something to talk about. So they create these funds, and you've still got these, these reps for these ETFs and mutual funds that come around saying, here's our shiny new product. And there's a lot of advisors out there that will just still, hey, like, cool, shiny new product. But then it comes to inflows. Okay. And let's face it, where is most of the investing still occurring in America? Inside retirement plans. And what's in most retirement plans? Static. This is one of the big problems with 401ks is your investing diversification is awful. Okay. The only thing you might have in it is fixed income that is remotely diversified, maybe a little real estate, sometimes if you're lucky. But I've seen some of the biggest companies out there, their 401k plan, large cap, mid cap, small cap, international, maybe have emerging markets, maybe have real estate, cash. That's it. Like, it's really, really poor. So this is why investing outside your 401k or having ways to diversify better inside your 401k is something, if you don't have it, you should be talking about. And there are some, options there to use, things like, your self-directed brokerage. This is a conversation to be had one-on-one with someone who understands these things. But what's happening is they come out with these new products, and then they look like, we only got, a couple, 400 million that came into that fund. Now, 400 million to you and me sounds like a lot. I've got some data on what the median income at different ages is. And it's sad because we look at the average, like the average income is like 150,000. That's skewed by several people at the top that have a lot of income. The median is more accurate because that's the middle. And there's, a lot of people don't make a lot of money. So 400 million sounds like a ton, but to a mutual fund company, that's nothing. That's a bad fund. They are looking for inflows in the billions if they're one of the top names. So what happens is they're not making enough money off of it. It's cool. It's got a little bit, but eventually that portfolio manager who they've hired and they pay big money to run these things is going to get told, figure out how to get the numbers up. And if you don't, here's what's going to happen. We're going to close down the fund or we're going to roll it into something else. Now, you talked about fund of funds, which I love because there's some horror stories on that. Again, going back to target date funds, which in many cases, target date funds, which again is that other area that 401ks have and most people are in. I see it. I look at 401ks. You'll look and say the company's 401k, 77% of the money in the 401k is just in target date funds. There is a horror story of a company out there I will not name that took their original target date funds. And what they did is they actually took money that went into those target date funds and they made the target date funds out of their fund of funds of their worst performing funds. Why? Goes back to what I said. To them, these funds weren't doing well on their own. They weren't making enough money. They needed more inflows to them. So instead of using their best funds, which stand alone, were getting plenty of investment dollars, They built their fund of funds out of the ones that weren't getting enough inflows. And therefore, by putting money into the target date funds, then they were able to filter out that money to the funds that stunk the most. That's a really good strategy for your clients, looking out for their best interest. Oh, by the way, the target date fund has an expense ratio, and then so does the funds they layered it into. So when you looked at the bottom line of the expenses, it was a stacking effect. Now, to be fair, this company got called out for it. They've changed that philosophy, and they've also taken and they've adjusted, these days fees have come down. But again, most people are not diversified at all. I threw some more charts in there. Kirk's pulling them up because I did throw an alternative chart in here. Here is some charts of more of your traditional static asset classes that more people have access to. This is showing international tips, a couple different types of bonds, real estate, a static commodities fund. Now this is one ETF company specifically showing those correlations, but the asset classes are going to act similarly. One thing, Kirk, you did talk about is it seems strange that bonds are less negative correlated than you'd expect. They're more non-correlated than negative correlated, and bonds have typically been negative correlated. One of the factors that went into that was 2023. If you recall what happened in 2023, the whole market crashed. We saw bonds crash because it was 2023. I might be off on the year, but I can't remember which one of that was that. But they raised interest rates. It crashed bonds. It simultaneously crashed stocks. By the way, this is another thing you have to understand about correlations. And also to add a tidbit in there, the gentleman you were thinking of, it was 1950s, was Harry Markowitz. That's who came out with right. the modern portfolio theory. And then there was Sharpe was another gentleman. They ended up getting the Nobel Prize years later for this. But basically, the correlation side of it, this is also a very important thing you need to understand if you're listening about correlations. And I'll turn it back to you, Kirk, is that correlations typically are more diversified in their returns in an up market. So this has been one of the challenges, is that the more diversified you are, you look and say, gosh, the markets are just blazing. Why am I not getting that? Because you're diversified. The diversification, this is where diversification is extremely hard for individuals. But the more diversified you are, it tends to, these correlations like, hey, this one's doing really well. This one isn't doing so hot. Add them together, your portfolio, you look at that return versus, hey, if you had just put in one thing. But what happens is when the markets go down, we tend to see correlations go up in a lot of asset classes when things fall. Why? Well, again, let's go back to mutual funds. Let's go back to ETFs. Let's go back to Bitcoin. Doesn't matter what it is. And you're going to start to see, now we are starting to see a divergence of correlation of Bitcoin. It used to be very highly correlated to tech and QQQ. That's starting to diverge. But we've been in an up market. Here's the thing. And we don't know exactly what's going to happen now because we haven't gone through a true recession, a true market correction, a massive long-term market correction in a long time. But the problem is that when people have other money in the markets through these mutual funds, and it's all brought together, and as you start to see the mutual fund or the ETFing of Bitcoin and things and investments like that, what happens is that when people get into a liquidity crunch, going back to the 6 major risks that people face: mortality, inflation, taxes, longevity. We talk about market correction. Again, when those things hit, people run into liquidity. I've got some data on job losses, by the way. We could talk about that and the age, per age, and people start to go, where do I get my money from? If it's all in the market, it's all leveraged in the market, and people put all that out there, guess what they do? They start to liquidate, and they start to liquidate indiscriminately. They need cash. Get me out. Sell, sell, sell. And it doesn't matter because most investors don't understand where to get the money when they need it. They just know they need to get it now. So so when you start to see everybody selling, boom, they sell from everything. Back to you.
Yeah, it's funny. I actually was fortunate enough to have met Markowitz earlier in my career, which was kind of cool. I got a picture with him. But I think what's interesting as Doug said a lot, and I think this is a deeper topic. We should probably get into it at a later date. But
you just get my juices flowing, Craig. You throw all these little things out there. I'm like, oh my gosh, I could talk so much about all of these things, but we don't have enough time.
That's all right. That's all right.
It's 9:03 anyway.
So. Yeah, we're at the hour anyway. So we'll wrap it up for next week. So we're gonna come back to you on Friday, and we'll be actually talking about government data, because there was a big segment I wanted to do on that, and we got off on a tangent on alternatives and correlations. But this is a really important topic. I did a research paper back in 2008, because we were mainly in cash in 2008 through the whole thing, and so we're sitting around doing research because we're just kind of waiting for things to happen. And some interesting things I found, as Doug kind of alluded to, is in normal times the markets are actually, so the point of diversification, to put it simply, is it gives you a smoother ride. That's all it does. It gives you a smoother ride. If hypothetically the S&P was better than international and small cap and mid cap and bonds, why would you ever put those other things when you could just put it in the S&P? Well, the reason is because if you put it all in the S&P, you would never stay in it long enough to realize the benefit of being in there. You jump out and jump in because that's the nature of investors. Whereas diversification smooths the ride, so it compresses the volatility. So instead of having this huge range of volatility, like negative 50%, above, plus 50%, it's maybe more like plus and minus 10%. So you're smoothing the ride, you're lessening the volatility, which makes it easier for most people to accept. Everyone's okay with volatility in the upside. They're just not okay with volatility in the downside. So what most advisors are doing is they're shrinking that volatility and compressing it so that it's not as big. So the swings are not as big. And because of that, it makes people more acceptable. Now, excuse me. One of the interesting things about this is some people will just say, just put it all in black and we'll just run it. Most people won't do that because of the downside. Now, diversification in general is not the preferred method. As Warren Buffett said, put it in the S&P and just leave it. In many ways, he's right. I don't know if that's the best investment, but in many ways, he's right. Just no one will do it. So, the whole point of diversification and Wall Street bringing this academic theory into the mainstream was to make it easier to sell mutual funds to investors. That's why they did it. And they stated that. It's not a secret. But everyone's just kind of taken it as a rule of thumb, even though it was never really meant to be. It was meant to be a sales tool. And everyone takes it as a rule of thumb now. Even institutional investors don't really know how it came to pass. So, it's interesting to note, like we talk about this a lot in the show. We call them Wall Street myths, half-truths, things that are sort of true, but not 100%. And because it's sort of true, it's also a lie. It doesn't mean it's bad. It just means if you don't understand why it is what it is, then you're going to get yourself into trouble. Diversification. Well, I am diversified. Well, it all went down 60%. Well, what happened? Well, it's because you weren't diversified. That's the truth of it. Years like 2022, when everything goes down, those are rare. They do happen, but they're rare. Normally, bonds and stocks are inversely correlated. You have them both, so they offset. As Doug said, if you don't have something in the portfolio you hate, you're not doing it right, because something is always
great line.
Yeah, if something is going to lag, you want it to lag because it'll lag on the upside and the downside. So if your portfolio is going down a lot, this should lag and should compress the volatility so it doesn't go down as much. That's the whole point. Now the reality is no one wants something that's crappy in the portfolio. And if you did that, you would never invested in value for the last 20 years or 25 years because value has underperformed. Same thing with Europe. Same thing with a lot of assets. But at the same point, you don't know when things are going to go up or down. You can tell about trends, like gold has done well, and then it took 3 years off, and now it's doing well again. That tends to do that. But if you don't know it does that, then you probably get frustrated in year 2.5 and get out, and then you miss the moves. So
gold has a greater standard deviation than the S&P 500. People think it's safe. It is more volatile. It's highly volatile.
Yeah, and unfortunately, certain assets like gold or emerging markets tend to trend strongly. So when they're on, they're on. And like emerging markets, you could go up a few 100%. When it goes down, you could lose 90%. So you got to be game for that. And fortunately, we're in an uptrend for gold and crypto and U.S. stocks. International's up this year, but who knows if it's going to continue? I don't know. I mean, we'll see. But you have to understand the trends, because if you thought I'm going to invest in Europe because this year is going to be the year, well, people have been saying that for 15 years and it was not the year. So same thing with value stocks. Doesn't mean you shouldn't invest in those areas. It just means that you're going to underperform the S&P, which that should not be the marker for everything, but that's what people use. And unfortunately, investors don't know enough to know that Europe should be compared to Europe. S&P should be compared to the U.S. REITs should be compared to REITs. And bonds should be compared to bonds. We have conversations with clients, and they own like a bond fund, and they're like, "Why is this fund doing so crappy? The S&P is up 20, and this thing's only up 3. Why do we own this?" Well, we own it because next year when the S&P is down 20%, you're like, "Why do we own that?" It's like, well, we own this other thing you didn't ask us about because it's up this year. So it's all a balancing act. A lot of it's psychology. Unfortunately, we're psychologists by nature now of our profession, because it's not just about getting the best return. It's also making sure that our clients they understand what's happening and they're able to ride it out, because there are bad years. Like 30% of the time, the S&P is negative. Out of 110 years, 30% of the time, the S&P is negative. 3 out of 10 are going to be negative years. It's just the truth of it. And so when people are like, what the hell happened? Like, the market didn't go up. Like, I didn't do it. It's like, it's the market. So there's a lot of this psychology that goes into it. And it's not just managing funds, because that's important too. It's also managing human psychology. We have a very complicated job in managing multiple aspects. And I feel like we do it well, but there's aspects that we can't control. And that's the unfortunate part. Most businesses are in full control of almost all aspects that they're dealing with. We are not in control with the one thing that everyone focuses on. We're in full control of financial planning. We're full control of advice. The one thing we're not in control is what everybody wants: asset management. We can't control the markets. And that's what everyone wants. And so it's this weird thing that I really don't like about our industry, because you could be highly competent in that one thing. There's only a few Stan Druckenmillers that have the 40 years of positive, 20 plus return percent. Those people don't exist. There's a few of them out there, but not many. So you're basically subject to the ups and downs of the markets. We're going to wrap it up. We're over time. Doug, final thoughts. Where can people find more about you?
Yeah, I just going to say this real quickly. I mean, you talked about the correlations. Let's go back, because I know it's the hot buzz. Bitcoin. So I looked it up. Bitcoin is about a 0.75 correlation to global money supply.
That's crazy.
No shock, right? And actually, if you go back to 2014, for the most part, whenever there's been a slight dip in M2 global money supply, it actually results in a significant shift to Bitcoin. So again, follow the money, right? Follow the Fed. I mean, it's one of those things like, oh, Bitcoin is just it's this Teflon. It's just no. There's so much money out there to throw at it, and it is where people are throwing. And so again, correlations absolutely matter. And let me tell you about correlations. There is a correlation between spending too much money for college and having a very poor outcome financially in your future. I'm going to college planning is wealth planning. And in the new big, beautiful bill that reshaped loan limits and shifting the game plan once again, they just did this a couple years ago. They're doing it again. The reality is that doing nothing is the fastest way to let Washington dictate your family's financial future. And if you think those changes are just political theater, remember the Department of Education is headed by Linda McMahon of WWE fame. So of course it makes sense. The only question is, are you going to let them slap you in a figure 4 leg lock? I remember kids doing that to everybody on the playground when we were growing up. Or will you climb to the top rope first and control the match? And here's the real truth. It does not matter how big your pile of assets is. And, Kirk talked about, controlling, the markets. And here's the thing is, you got to know what matters to you. You got to know what you can control, and you got to stay in the space of where you can control what matters. And what matters is the income you can reliably draw from those pile of assets without running out. That's why I am starting to see more families with $2, $3, $5 million or more that still run. They're still worried about running out of money. You want to know why? They don't have an income plan. They have accumulation, but they don't understand distribution, and it worries them. College is one of those biggest drains. Do not let tomorrow's income be silently drained by today's tuition bills. Most high-income families are just going to write the check, usually after tax dollars. They're going to drain the capital, and they're going to hope it doesn't hurt too much. The outliers, the ones that are going to treat college planning as part of a bigger income distribution strategy, open to new ideas to make sure they protect their wealth and their retirement and preserve compounding, are going to keep their legacy intact. So ask yourself, are you going to be caught in the hold, or will you be the one to climb out first? You can do it different. Get to the top rope before they do. Visit mergentadvisors.net. That's MERGENT advisors.net or mergentcollegeadvisors.com. MERGENT. Let's make sure that you're dictating the match and you're not taking the pin.
Nice end, Doug.
Thank you.
Very, very cool. All right. So that's the show for this week. Thanks again for joining us at Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do.